Let's go across to Pankaj Tibrewal, the Senior Vice President and Fund Manager at Kotak Mutual Fund. A long India bull who at the start of the year was saying this is India's decade. This is the year we're going to see a lot of uptick in manufacturing. He was bullish on the capex cycle being played best with banks and, of course, manufacturing textiles. Pankaj, good morning. The first question I have to ask you is, we're talking in a morning where we got news that Bill Ackman has lost nearly $500 million in just a few months on his Netflix investment. Look at the volatility globally. Nobody's able to make sense of it. Back home, look what's happening with the blue chips. Nikunj Dalmia is calling it the blue chip fatigue. If there's going to be a fatigue for large caps and blue chips, what are you supposed to tell your clients? What are you telling your clients?
Yeah, good morning. If you remember at the start of the year, we said that this year will be a year of consolidation with heightened volatility. And we should be focusing this year more on capital preservation. Though the medium-term outlook for India looks extremely positive, but this year needs to be navigated carefully. I think a few of the concerns which we are having. First, I think for the next few quarters, we would see limited earning support because we are seeing margin compression across the board. And don't forget, from September 2020, the rally which we saw was supported very strongly by earnings growth, not only in India, globally. But incrementally, we believe that pace of earnings upgrade will slow down. And in some sectors, we are staring at an earnings downgrade cycle to start, led by elevated commodity prices. Second, I think interest rates across the globe have started rising, and central bankers are running behind the curve. Inflation is, 3-decade, 4-decade high in many of the countries. And our worry is that the central bankers may overreach in terms of interest rate hikes, as well as quantitative tightening. The third one is that elevated commodity prices increases the odds of a global shock. And when you combine these things along with the FI selling, I think this year will be range bound, consolidating, and the focus should be bottom-up stock picking. And that's been our communication to our clients as well, that treat this year as a consolidation year rather than making money going in 2022. Also, don't forget that in US, there's a very strong correlation with rising interest rates and underperformance of tech. And we have seen there the 10-year benchmark almost touching 3%. And the way NASDAQ has reacted, it's down almost 15% calendar year to date, and many stocks are down between 40 to 60%. So clearly, we are seeing that pressure being built in on the tech stocks there. As interest rates rise, it will act as gravity on very high valuation stocks. And we are not very surprised by this move.
But Pankaj, I know we're not supposed to look very short term, but is this a mood change that we are seeing now when it comes to a bunch of large cap stocks? And these are the ones that are, credited for taking the markets higher. Infosys, HDFC Group. For the first time, you now even have ICICI commanding a premium against HDFC.
So yeah, a part of that could be because of the technical reasons on the FI selling. We have seen unprecedented selling by FIs over the last 6 months. More than $20 billion have been sold by FI, and domestics have been a big support to the market. I think a large part of the holding of FI are in the names you just spoke about, or the blue chip names. And obviously, when the ETF selling or the FI selling happens, it mostly is reflected in the index. But one data point which I would like to share with you, that somewhere on a rolling basis, the FI selling as a percentage of GDP is almost coming close to 1%. We have seen in the past that whenever that number of one quarter hits it, either the FI selling slows down or there's a reversal in terms of FI becoming buyers. I don't know what will lead to that, but there's a high probability that as we move ahead, the valuations will protect FI from selling more of these blue chip names. As a house, I think we are seeing value in many of the blue chip names. And our house call is that we should start going slightly overweight on large caps. And we believe that over a period of time, these large caps will offer value, and they are offering good growth as we move ahead. And they have the balance sheet to withhold the volatility. So I think a good time over the next 6 months to deploy your capital gradually over some of the blue chip and the large cap names.
Hi there, good morning. I wanted to understand what the outlook is after having read into the kind of quarterly numbers declared by the IT companies. You know, the street clearly gave it a huge thumbs down, and we saw even the overall valuation picture getting quite challenged when it came to the mid and the small and the large cap IT names. How are you reading into the overall valuation picture, the growth challenges, attrition rates, etc., when it comes to IT? And do you think that after this quarter, perhaps we can see some amount of stability kicking in when it comes to earnings?
Yeah. So what we have been saying over the last 6 months is that a large part of return in IT companies have been because of PE rating. Yes, they delivered on earnings growth, but if you plot the total returns delivered and segregate it between earnings growth and PE expansion, a large part could be contributed because of PE expansion. And the first reflection came post the third quarter results, when the companies reported very strong results, but the stock reacted negatively. And that was the first indication that we could either see some time correction, which could lead to PE adjustment or absolute PE derating. And I think we are seeing PE derating happening now. I think market had factored in a lot of growth. And what came as a surprise is the attrition rates in some of the names which have been reported. Large caps are seeing 26 to 28% attrition, which they have never seen almost in last 10, 15 years. And that's leading to some kind of margin pressure. So the demand momentum remains strong. The commentary and the pipeline of deal flow has been extremely good. But margin pressure is something market is trying to readjust. And our sense is that next 6 to 12 months, we could see earnings growth coming in, but there could be some kind of PE derating, which can happen, and markets may readjust the PE multiple as you go ahead. So that's why we have been a little careful and cautious, especially on the midcap IT names, where we believe that there could be some reset to the PE multiples as we move ahead.
Request you to just stay on with us.
Hi, good morning. This is Anisha joining into the conversation as well. We have been talking about the entire buzz in the cement pack on account of the news regarding Holcim looking at exiting its stake in ACC as well as Ambuja, and that could mean a big acquisition coming in, an important one at that for rest of the players. What do you make of this particular event, and how are you looking at the cement pack, given there is a very evenly balanced amount of headwinds as well as tailwinds that the sector is facing?
So on the cement side, let's break the discussion into two parts. One, let's talk about the sector and our view. And second, the buzz or the rumor of the deal going through or not going through, we'll spend some time there. On the first part, on the cement side, I think we are positive on the sector as a whole. And we believe that when you look at from a slightly medium-term perspective of next 2 to 3 years, the supply side is constrained. There are not too many capacities which are coming on the cement side. And we believe that the demand would at least move between 5 to 7%, basically led by real estate and infrastructure. And I think if that's the case, the pricing will be quite strong, barring the near-term volatility where raw material prices have gone through the roof. Coal prices are in excess of $300, and that's putting pressure on the margins of the cement company. So barring the near term, I think the structure of the industry is quite good. Consolidation has played out quite nicely over the last 5, 6 years. And there doesn't seem to be too much of supply coming into the sector. So that's giving us a positive outlook from a medium to long term. Now look at the talks about or the rumors about large group exiting India on the cement side. I think the way I look at it is from a positive perspective. think about it, about 12 to 14% of India's capacity will change hands. Earlier, the group was, had set up the plant at say 2,000, 3,000 rupees per ton. Anybody who buys it will buy in excess of say 10,000 to 15,000 rupees per ton. And person who invests such large pool of capital will look to buy or look for returns, at least 10 to 15% return on capital. And that means a lot of pricing discipline would be there in the industry, whoever, plans to buy 12 to 14% of India's capacity. So I think it will bring a lot of discipline, the way I look at it. But we are not, we don't know whether any such deals are happening. We are just reading the same media reports which you are reading. But in case such deal happens, it will be positive from a pricing discipline perspective, because 12 to 14% of India's capacity would change hands at a higher price. And I presume the buyer would think about return on capital, 10 to 15% on that capital invested over longer periods of time. And that will bring a lot of discipline in the industry.
Okay, that's an interesting take regarding the entire cement pack, as well as what to make of the reports that all of us are reading regarding one of the large players exiting the Indian markets. But Pankaj, if you look at the markets today, the top two gainers are the underlying commodity plays, Coal India as well as Reliance Industries, which has hit a fresh high today at 2764. And you were talking about, earlier in your first answer that there is some of the sectors which are likely to see upgrades while others might see downgrades. Is commodity one sector which still has some steam left to move on the upside? And specifically, if you can talk about Reliance in terms of the GRM moves that we are talking about, which is at a record high level, what do you make of this sector?
So we can't talk on stock specific, but our sense is that commodity prices are very highly elevated. And that's increasing the risk of a global shock in our view. Look at this way. The global GDP is roughly about $100 trillion. The oil market today is about $4.5 trillion, which is 4.5% of global GDP. Add to that natural gas, add to that metals, and add to that food, the soft commodities. You're talking about the contribution of all these now in excess of 15%, which is more than 15 trillion to the global GDP. Don't forget that any incremental change, which means that the incremental surplus is moving to the producers and somebody has to pay the bill, either the government or the consumers. So that surplus is getting lowered and moving to the producer surplus. My sense is that there are supply side issues on the crude side. No incremental new discoveries have come in over the last 3-4 years. No new capacities on steel, aluminum, copper large capacities have come in. And as a result, there's an intermediate demand supply mismatch, which is leading to elevated prices. But at some point of time, from a medium term perspective, these elevated commodity prices will lead to inevitably a demand destruction. And that will bring down the commodity prices lower. Maybe it may be higher than the last 5 years average, but such high commodity prices may not be sustainable in our view over longer periods of time. So I think in the short term, yes, the odds are that prices may remain elevated because of geopolitical and supply side issues. But from a medium to long term perspective, they need to revert back to mean. Otherwise, there will be demand issues globally. And we are already seeing early signs of that.
Pankaj, hi there. I also wanted to understand your outlook when it comes to the entire consumption basket. With the inflationary raw material prices going higher, the expectations are that volume growth will be dampened. Companies have undertaken price hikes in order to mitigate the impact of the same. Do you believe that one needs to be very selective when it comes to the entire consumption space, also with looking at commanding valuations?
Absolutely. I think in the near term, we may see margin and volume pressures both on many of the consumer names. And our channel checks suggest that companies are not able to pass on the entire price increase to the consumer. So I think over the next couple of quarters, we should see earnings downgrade in this sector, especially in some of the consumer discretionary names, some of the consumer staples names. But that will provide us an opportunity to buy into some high quality franchises at decent valuations. So I think clearly over the last 12 to 18 months, if you look at the consumer staple basket has underperformed quite substantially to the overall market. And I think that could be the case for the next few quarters as well. But that, whenever we get an opportunity to buy at decent valuation some of the great dominant franchises, we won't shy away. Actually, we are looking at such kind of correction to dip into because the medium to long-term story on consumption remains robust. Yes, there are near-term headwinds, and we will look to use those headwinds to increase our exposure to that sector.
You know, auto presents a lot of opportunity, particularly when it comes to the EV space. We understand that, India is expected to become the third largest market for electric vehicles by 2025. But there are a lot of challenges as well being presented on the same in terms of, a very high cumulative investment and, the EV charging stations as well, which require a high price. How are you looking at, the stage being set for EVs? And what the challenges are when it comes to the automobile industry fulfilling this ambitious challenge?
So I think India is going through a massive transition from ICE engine to EV. And I think globally that's happening. And our sense is that most of the global manufacturers, as well as Indian manufacturers, will look to transit from ICE to EV. Now, what is not established is whether the ecosystem will be more hybrid or it will transit completely towards EV. Because don't forget that on the EV side, battery is very, very important, the lithium-ion battery. And India doesn't have too much of reserves on the natural resource on lithium. So finally, we would be dependent on China for our raw material purchase. So whether green hydrogen is the right way, hydrogen is the right way, or EV through lithium-ion batteries is the right way, only time will suggest. But there's a massive transition in the auto industries which is happening. And we need to be navigating this transition very carefully. There could be many companies which will destruct values. There will be many companies which will create enormous value, which we have seen globally as well. And we need to really pick and choose the right company in this sector. Otherwise, over the last 3-4 years, we have seen that many of the companies have not created the wealth they ideally should have, and we should not be in a value trap. So we are very carefully evaluating this space and keeping our heads down and doing channel checks, looking at the ground, what are the changes happening, and then probably taking a call. But yes, for sure, there is a transition happening in the entire auto ecosystem as we speak in the country.
But I wanted to pick your brains regarding two smaller sectors, that is defense as well as power. Now, we are talking about order inflows coming in for the defense sector, but do you think it is the right time to make it as a serious investment going forward? And power has been one space which has been a laggard. People have been talking about growth versus value when it comes to the power sector as well. What's your take regarding where power sector is headed?
So two very good questions. I think the first one is on the defense and capital goods. And we have been advocates of revival in manufacturing and investment cycle for almost more than a year now. And we are seeing more and more evidence emerging, which is supporting our thought process that finally, after a long time, manufacturing is seeing uptick in India. And that's led by 2-3 things. One, the entire PLI scheme has started to gain traction. And sector after sectors, we are seeing that companies have been allotted licenses. They are investing in factory and buildings, and probably next 2-3 years could be very strong in terms of sales. The second is the China Plus strategy. Companies may not be coming out and talking about it openly, but sector after sector, when we are evaluating the export data, we are seeing strong momentum. And this year we have crossed, which was FY22, more than $400 billion in export. And engineering exports has crossed more than $100 billion. That's a very substantial number. So I think the China Plus, it's playing out its role very silently, and companies after companies are seeing orders being diverted from China to India. The third part is obviously India becoming more Atmanirbhar, and defense is playing a major role. Countries have realized the need to spend on defense after the geopolitical tensions, what we are seeing between Russia and Ukraine. And Germany came out with their statement. China, we have seen the defense spends being higher than the GDP growth. And similarly, in India, we are realizing that we need to be more Atmanirbhar and have more indigenous production rather than depending on imports. And I think that's a very sunrise and a very strong sector, though we need to factor in that the orders will take time to actually materialize and become a part of your order book. But never said that, companies are extremely bullish, where it is in private sector or PSU, and we are seeing strong demand traction. And many of the companies are part of our portfolio on the defense theme. So as a theme, we like capital goods and defense, and we believe that there's strong momentum building in from a next couple of years perspective on this theme. On the power side, I think, as I said and explained about cement, I think on the power side, on the thermal, we haven't seen any new big capacities being installed over the last 3-4 years due to ESG and various other concerns. I think in the near term, the power prices may remain firm as we see strong demand into the summer season. But over a period of time, I think renewals will catch up, and probably that should provide incremental capacity to meet the demand. So yes, near-term power stocks may do well, and power sector may do well because of the firm demand on the power side.
So that's the word coming in on the defense as well as the power space. But we will let you go on that note. Appreciate your time and joining us with your insights on the sectoral bets that you're looking at this point of time.